Thanks.
Morning, everyone. Wonderful to be with you. Thanks for joining us. And it's really, I think it's a fascinating article, and really look forward to unpacking it with you, Duke. So very quickly, Mano Iyer with Sofinnova Partners. Sofinnova is a 50-year-old venture capital firm based in Paris with over 2.5 billion euros under management. I specifically work with an MD Start, which is a very early stage medical device accelerator, kind of turning ideas into companies. We've created 13 companies over the past 15 years. And in my former lives, I started and exited 2 companies. So really fascinated. I've been on the, the VC side of things, right, on the corporate side of things, on the entrepreneurial side of things. And I think your background here is fascinating. But I'd love to start maybe with just maybe if you could explain quickly to the audience what we're going to talk about. What is the growth driver and chassis model that you've architected here?
So at the highest level, what we have tried to do is eliminate as many risks in the development process as possible. And what we have found, or I have found specifically running companies for the last 20 years, is that what you want to try and do is isolate down to just technical risk by eliminating capital risk, eliminating market risk, eliminating development risk, et cetera. And so what we've tried to do is figure out how we can eliminate that market risk. And so our idea, our chassis concept, is that you find a commercial engine. And in this case, it was Cardinal Health's Cordis. And you identify the deficiencies of that portfolio. And then you identify which technologies can be built, which technologies can be bought, which technologies can be licensed to offset the deficiencies in that portfolio, and then you fund them. And so we ended up partnering with 2 big private equity firms, Hellman Friedman and KKR. We bought Cordis and surrounded it with a $300 million engine that was specific to developing new technologies that Cordis needed.
Right.
That's the model.
Yeah, thank you. There's a lot there, and I think we'll go through and we'll unpack that. Yep. In our time. I would love to start. I mean, it feels like the foundation for this, normally we kind of do a very short bio and jump into the content, yep. But your bio is highly relevant to how you got here, right? And I think there's so many unique experiences and so many success stories which you've built upon to get here. And I think if I understand correctly, it really started with your appreciation for the importance of leadership and capital and risk in the restaurant industry, if that's right.
Yeah, believe it or not. So out of Stanford, I ended up graduating into a really, really tough economic environment and decided to start a restaurant. And the restaurant sort of taught me the core tenets of how to start a company and how to manage a company. And I ended up growing that restaurant to 10 restaurants, and then we sold it to a much bigger restaurant company. And at that time, I was asked to be the CEO of Sizzler. And I looked down that path and said, I'm not really cut out to be the CEO of Sizzler. That's not the life I endeavor to live.
How do you explain Sizzler to a European audience?
Oh,
I'm not
Sizzler
sure.
is,
you don't have to.
It is, yeah. It's a little bit above McDonald's, put it that way.
Selling steak.
Yeah, not great. So I went back to business school and entirely focused on going into another space where I thought that I could have an impact. And the reason I chose medical devices is I had a ton of experience working with chefs. And chefs, in a lot of ways, are the smartest guys in the room, as are doctors. As we all know, doctors are the smartest guys. My brother's a doctor. My dad's a doctor. So I'm very familiar with it, and I can use that, not in a pejorative term, but I can definitely poke fun at doctors. But they're very, very smart. They're trained to be exceptional at what they do, but a lot of times they don't have the other capabilities that are required to actually drive a company to success. And so I went back and decided to focus on going into medical device without too much experience, no experience in the healthcare space at all.
And that leads you to Fox Hollow? How did you work your
Yeah, so my first job was at a company called Lumend, and I went in as the head of business development and ended up selling that company to Cordis, believe it or not. Cordis was just the company that I bought 3 years ago. And I remember looking at this company. We had infrastructure, we had marketing, we had management, we had clinical, regulatory. There was so much infrastructure associated with this single little product. And I remember thinking, gosh, it's going to be really hard to get a return on that investment. And because they'd had $45 or $50 million put into not a therapeutic catheter, but a niche catheter. And they ended up selling it for about $45 or $50 million. So from the perspective of an outcome, it was a success. But from the perspective on, money on invested capital, it was a failure. And I thought, gosh, there's got to be a better way to do that. Fox Hollow, which was an atherectomy company, had just reached a terrible inflection point. They were targeting the heart, and drug-coated stents had just come out. And so the market for drug-coated for atherectomy in the heart went away. And so I came in pivoting that company, never having run that company, but it was on sort of a downward trend. So they were willing to take a risk on me. And we ended up turning that company around and growing it to be very successful. But we mimicked a lot of the failure modes that we had seen at Lumen. We were very, very infrastructure heavy. Our SG&A was like 140% of our revenue. We had very limited clinical data, and we were very, very good at what I call iterative improvements, coloring. Orange and black was our marketing motto, and everything was orange and black. And we ended up growing it to be sizable, $200 million in sales, and selling it. But it was that success actually hid a lot of the failure components that I think bring down technologies, and I sort of vowed not to do that again.
So you get experience on the commercial side of things, and you build a belief in efficiency, which leads you to CV ingenuity. Is that right?
Yeah. So Fox Hollow, we spent a lot of money. We went public. We grew it. And then when we sold it, I said, gosh, there's got to be a better way. And I went back to the drawing board and said, let's develop this technology. Let's see if we can spend 30 million, not 100. Let's see if we can develop a technology by making trade-offs, things that are not critical to the differentiation of the asset, but could be leveraged, right? So instead of building our own balloon that was going to be carrying the excipient and the drug, we partnered with Covidien at the time that had a great balloon. And we focused all of our energy on the coating and the excipient. And then let's see if we could sell it for $300 million. So three years, $30 million, 300, which was very, very different than the Fox Hollow trajectory. And it forced us to be incredibly lean. Our office had no windows. We were on this very big highway. If you opened up the door, you were overcome by the amount of noise that the road was making. But we were incredibly efficient, and we ended up doing it. So Fox Hollow, I feel, hid a lot of the expense that I thought needlessly went into companies. CV Ingenuity was the other extreme. It was incredibly efficient. When we sold it, we still had $10 million in the bank, right? And so it was the capital intensity, the capital efficiency was there. But I realized that we probably could have raised more money and realized more money from an exit if we had done a little bit more. So then I started another company called Spyrox, which was in the ear, nose, and throat space. And I was trying to combine the capital efficiency and the lean operating mentality of CV Ingenuity with what became a skeletal commercial entity that mimicked Fox Hollow, but instead of building a 200-person sales force, we were going to do it with 10. So this was a technology that went into the nose. It was an ear, nose, and throat. It basically replaced a procedure that was highly invasive for nasal valve collapse with almost like a little fork that you put in a minimally invasive setting, and it basically propped open the nose. We were capital efficient. We got to design freeze with like $2 million, and then we got through the FDA with about 10. And then instead of building a massive sales force and trying to be a competitive company to single product companies, which are it's really tough. I was pulling up some data for this talk, and if you look at the top 25 companies that are $300 million or less in the public markets right now, all of them are down on average 80%. All of them have SG&A numbers that average to about 130% of sales. And in the last 12 months, they've gone down 30% on alone, right? So being a single product medical device company that's public is a very, very tough road. There are exceptions, Shockwave being one of them. Fox Hollow was one of them, but it was, I think, one of the last of its kind. So we were under the impression that we could basically do a small amount of investment, raise 10 sales reps, and go demonstrate the utility of this technology with a cohort of physicians that were supporters of it. And instead of building the requisite infrastructure to scale, we were able to demonstrate that this small group of people could do $1 million of sales per rep. And it translated to another company coming in and saying, gosh, if we just put 100 sales reps, we're going to get a lot more revenue out of that. So it was a modification of both Fox Hollow and CV Ingenuity.
Yeah, fantastic. And so, I mean, you have some wonderful success stories already, and you're not happy. You say, well, there's still room for improvement. There's still learning here. And we're not able to control our destiny on the upside because corporations are now buying these technologies, and a disproportionate amount of the upside then goes to the acquirer, right? And so that leads you to Epix, is that right? I mean,
yeah, so Epix, then I started another company called Epix, which was in the electrophysiology space. And the idea there was we were going to create a portfolio of companies. So this was the precursor to the Ajax model, the model that we did ultimately implemented with Cordis. But we were going to put this very cool new ablation system with mapping and some of the other capabilities. And what we were going to do is sell it to one of the companies that wanted to be in electrophysiology, but didn't have the products and didn't want to go and piecemeal buy 4 or 5 different technologies and put them together. And it worked from the sense that we ended up selling that company to Medtronic for a lot of money. It didn't work in the sense that we had disparate investors who were not willing to come to the table and play the game. We needed someone who was going to develop mapping, someone who's going to develop the sheaths, someone who's going to develop the transeptal cross, all the different capabilities that you need to have a full service division. And so I ended up selling that company and feeling like there was still more we could do, right? Mm. And that's when I looked at Cordis, and Cordis was a very neglected asset at Cardinal. It had been at J&J, and that it had been divested to Cardinal, and then Cardinal was trying to get rid of it. And so I looked at it and I thought, gosh, this is an unbelievably interesting opportunity. It's a company that had zero growth. It was $700 million in sales and basically no growth and almost no profitability. And so I think people thought I was probably smoking crack when I was really excited about buying this company, because I felt that, gosh, it was the perfect venue to put this growth driver engine around and transform it. And so we ended up buying it. We ended up buying it at a very, very discounted price. We paid $1 billion for it, which is about 1.3 times sales. And if you look at comps for companies that are not growing, that's about what you get. If you start growing at 10% and you have a revenue base, you start getting into, 3 to 4x. If you're above 15% growth on a compounded basis, you can get into much higher multiples than that. So the vision was that we were going to go buy this company. We're going to surround it with these growth drivers. We're going to take a company that we bought for $1 billion, take a 0% grower, transition it to a 10% grower, take a 0% EBITDA company and make it profitable. And we're on that track. We'll do $1 billion this year. We're growing at double digits. Our profitability is double digits. And more fundamentally, the model is working in that it's got, over the next 5 years, every 6 months, we're kicking in a new technology that's coming from this engine that is called the Cordis X, which is the accelerator engine.
So can we talk to the models? It's fascinating, and how you actually implemented it in Cordis X. So I understand that there's kind of three buckets, right? The first is really identifying opportunities, and you really need to work with the corporate. In this case, you had specific insight because you were buying Cordis, but how do you start? How do you identify the right opportunities that make sense, that are not incremental R&D and not big, huge VC bets, right? That kind of fit this middle path, as you call it.
So one of the problems, I think, with the medtech venture investment world is that everybody's focused on what I call transformative technologies. Okay, so transformative technologies are technologies that I was focused on too. It's what gets it's what attracts the venture capitalists, right? They come in, they say, gosh, 9 of these technologies are going to fail. We need to have one that's going to be a home run to carry our fund. Let's focus on the ones that have the highest beta, meaning the highest risk, but also the highest return profiles. And yet those are the highest risk and take the longest, but they also yield the most amount of money. They're very, very hard to do. On the very other end of the spectrum, you have iterative technologies. And iterative technologies are technologies that are typically built by in-house R&D firms, right? So if you're Boston Scientific, what you're really good at is iterating on what your current products are. They're not good at building transformative technologies. Those days are done. Then there are synergistic technologies. And synergistic technologies are technologies that venture funds don't want to fund, but they accelerate the growth profile of an existing product in the portfolio. So for example, you have an ablation catheter, and you need to have a balloon that goes with that ablation catheter that's specific to that. No venture firm's going to fund that balloon, but they need it. The big companies don't want to spend that money because it's a little bit beyond iteration, but it's also really needed. Then there's a third category, which is incremental. And incremental are tuck-ins, tuck-in technologies that you need and that, again, aren't sexy and that don't command 10x returns on the invested capital. And so what I looked at, and I said, we have to span that continuum. We have to have enough transformative technologies, but then we also have to have enough iterative technologies, synergistic technologies, and incremental technologies that this becomes a really powerful engine. And so our model is not to develop those in-house. So what we did is we came up with a list of things that we wanted to do, and then we went out to the ecosystem of people that have worked for me in the past. And I said, do you want to run your own company? And they said, yes. And I said, okay, I want you to build this sheath, and I'll fund it, and I'll buy it back from you on a predisposed price. But you're only doing this, and the predisposed price is like 3 times invested capital, not 10. And we've done that like almost 23 times now. And so what we've done is we've taken great people who have a really keen interest in being entrepreneurial, who have a challenge in doing that because they can't get capital. There's so many challenges, so many impediments to being able to develop a technology, and we've harnessed them, right? And put them to work. We've funded them, and they're all very, very myopically developing technologies for Cordis.
Yeah. So just on that step one for a moment, just on ideation, and you had unique experience with peripheral, vascular disease and cardiology, and of course Cordis is well known for, I think it's access, treat, or access, diagnose, treat, close, and so these types of devices, guide wires and guiding catheters and sort are well known. You mentioned drug-eluting balloons. Can you just give a sense of what were the types of products that you ultimately made for them? What fit? Like, how did you fit the gap?
Yeah.
Fill the
So
gaps here?
we looked at we decided where are we going to be? Are we going to really go into coronary? Are we going to go into peripheral? If we're going to go into, and we had like 5,000 SKUs at Cordis, and about 2,500 of those SKUs were not even being sold, right? We were selling in 60 countries. So we had to really clean up the strategy, clean up the house, make sure that what we were going to invest in is actually going to have a difference. What we ultimately decided is that we're going to go very, very heavy into one aspect of the heart and one aspect of the legs, leveraging a drug-coated balloon, which is something that I was very focused on and familiar with based on CV Ingenuity. But then we developed sheaths. We have closure devices. We have some transformational technologies like IVL, next generation IVL. We have a whole carotid portfolio that we're developing. All of these are part of the purview of Cordis, but had been neglected, and we ended up feeling like all of these products, whether they were iterative or transformational, would be impactful.
Yeah. And so, our industry is predicated on intellectual property. So how do you think about that in this process? Because it seems like you can be walking a fine line with some of the developments that you're talking about.
Yeah. So I've never had a problem with intellectual property, to be honest with you. We don't violate it, but we, with really creative minds, we have been able to get around the intellectual property barriers and the picket fences that have been put up around some of the key technologies. But we spend an enormous amount of time making sure that the ideas are going to both hold up as well as be uncontested going forward. The bigger issue was timelines, right? So you have to make sure that if you're putting something into the carotids, that you have a transformational technology that's going to come online at the same time as you have all of the other, all the other pieces of the portfolio for the carotid that would make sense, because that's how you get the leverage for your sales call point. The reason a lot of these companies have an SG&A budget of 140, 150% of their revenue is because they have one product selling into hospitals, so there's no leverage, right? So we wanted to have a portfolio so that we could go sell into the carotids and get 5 touches versus 1 with that doctor.
Great. So you know what you want to make. Step 1. Step 2 is you have to fund it, and you created a $300 million incubator in Cordis X to do it. Can you speak about that? I mean, how do you think about that? How do you think about the amounts? How do you think about, you'd mentioned timelines, of course. We're glossing a bit over, development timelines, regulatory, clinical. There's a lot there, right? And there's potential delays. How do you think about the amounts you need and how to, going forward, to get a corporation to invest in something like this?
It's a really good question.
You have the answer.
No, so what we became really good at, not so much with Fox Hollow, but CV Ingenuity in past and beyond, was being incredibly good at figuring out cost. To the point where we would have a budget for a company that started from the time we had design freeze, right? So you can spend $1 million or $2 million and have it not work and be okay. If you spend 15 or 20 or 50 or $100 million and have it not work, you're in real trouble and your career's over. So we would be myopically focused on cost when we were developing the product to get to design freeze. And we became very good at hitting those numbers, whether it was 30 or 40 or $50 million to get through to what we called the liquidity inflection point, not to the sale, but to the point where you could sell it or you could raise money. That's the inflection point, liquidity inflection point. We became really good at that. And what that allowed us to do is transition from venture investors to private equity investors. So with Spyrox, I went to KKR, which is it's got aspirations to be $1 trillion investment firm. And they're at about $600 million right now. I know them very, very well. And I said, listen, try us on. Like, we've done Fox Hollow, we've done CV Ingenuity. Here's our budget for Spyrox. And it was very, very detailed out. We'll hit it, and this is the kind of return we're going to get from it. And it worked. I don't know how it worked, but somehow it worked. And they ended up saying, gosh, this guy knows what he's doing. I didn't really, but I had a pretty good idea of what, wasn't too hedged, but it was hedged enough that I wasn't going to miss it. And so then KKR became a partner to us, and KKR then backed Epix, and then KKR backed Cordis, and along the way I brought in Hellman & Friedman, which is a super elite private equity firm that I have tremendously high regard for.
Yeah. Just along those lines, I mean, how do these firms have hundreds of billions under management, right? And how do they think about investing in early, mid-stage medtech? I mean, today is a big day in the markets because the Federal Reserve is going to decide whether to, change interest rates, which is, I mean, for many of us who are in the startup world, you don't think about that, right? You're taking big long-term bets, but for companies with this much capital, it significantly changes or modulates their definition of risk, right? So how do they think about this, and how do you convince them to invest?
So the previous discussion was about the profile of medtech as an investment class and what's going to happen, the war between Israel and Palestine finishing up, et cetera. Historically, the medtech in the last 15 years as an asset class has been deplorable, right? So if you're an institutional investor looking at investing in industrials, looking at investing in real estate, looking at investing in biotech, the last thing you're going to do is allocate money to med tech. And why is that? If you look at the amount of money, so if you take the top 25 med tech companies, top 25 largest med tech companies in the world, they're spending about $45 billion a year on R&D and about $45 billion on M&A. All right, so it's $100 billion. They're still challenged by innovation. So there's this dichotomy. You have this massive, massive need for innovation, which these companies are right now paying for because they can't build on their own. And then you have a broken asset class, which is the venture guys. It takes 10 years, 12 years. If you invest in a Series A, it's highly, highly risky and probable that you're not going to get very much return 10 years later. That's just not interesting. People invest on a 5-year cycle. So what's happening is that people, and the reason our model got traction is people are saying, gosh, how do we solve that problem? How do we solve that innovation problem, but at the same time create an interesting asset class? And to create an interesting asset class, you have to do a few things. You have to, reduce risk, right? So single product companies are highly risky, right? There's a very, very significant probability that they'll fail. We've all been part of those. Single product companies are inefficient, right? To get the traction that you need to develop and create someone wanting to buy you, you have to spend enormously on infrastructure. Single product companies are beholden to a buyer universe that has all the power. Okay, so if you look at the big companies, and if you look at the companies that are being sold, everybody's got a company, but the big companies are only buying the best companies, and they're typically not paying a lot of money for it, right? So what we decided is, gosh, let's take those risks out. Let's have a portfolio of technologies. Let's have capital that doesn't put us in a position where if we run out, we're recapitalizing the company. Let's be highly, highly focused on a therapeutic area. And if a strategic doesn't want to buy it, we could take that company public. So that was we were creating what I call BATNA, which is the best alternative negotiated agreement. It's the ability to have an outcome if and when the intended strategic buyer decides not to pull the trigger and buy you.
I think you nicely elucidated it in the article where you talk about Cordis being $750 million of revenue, about 1% to 2% growth, and if you could increase that to 8% to 10%, you go from a $1 billion market capitalization to $5 billion, right? Yeah. And then you're able to, everyone benefits, right? You're able to be a shareholder in that process, whereas if you have a product sold within a division, it's the equivalent of cash. You're not getting anything, right? Because it's locked up, and we can't benefit as external shareholders. Great.
That's exactly right.
Yeah. So step 1, ideation. Step 2, funding. Step 3, you actually need to make products. You need to execute. So can you talk a bit about how because this is really a very unique part of this structure, right? Yeah. About efficiency, capital efficiency, talent efficiency. So can you kind of walk us through that?
Yeah. So what I've found in med tech companies is there are incredible engineers, right? There are incredible engineers, they're incredible people, but they're not fit for purpose as CEOs. Or if you're a CEO and you're a talented CEO, you need the engineer. It's just, so instead of doing that, we said, let's go and let's mimic the App Store model, right? Let's go find app developers. In this case, they're engineers, people that know how to build a technology. Let's talk to them about what we need, and let's then empower them. We'll provide the financial oversight. We'll provide the capital. We'll oversee, the development of it. But they're in charge of taking the idea that we give them from start all the way to finish. And when they don't have to focus on raising money and they don't have to focus on, trying to get a strategic involved, et cetera, they're incredibly efficient and they do that incredibly well. So there's a nice Wall Street Journal article written about our model, and they talked about how we take an 8-year timeline from a development standpoint down to 3.5. And it's not us, it's actually the people that are developing those technologies. You take away all of the challenges and all of the things that are non-core to developing the product, and they're very good at it. Mm. And so then we just started populating, developers to build these technologies. And we've grown that. So now one of the core differentiators of Ajax is having this ecosystem of incredible talent. And, you know, we're less inclined to go buy one of your technologies or invest in your technologies. We don't do one-off, but we're highly, highly incentivized to come in and bring you into our ecosystem and have you guys become a developer for us. And it gives you the ability to take away market risk and take away capital raising needs and get really good returns very quickly.
So can you get into details a bit? How does it work? You have the accelerator, which is funded, and you have a list of ideas that you want to work on. How do you find the talent for the individual? Was it in a group? You're putting out RFPs for trying to find different groups bidding on the different technologies, so it can end up spread across a number of different development pathways. Is that right?
We typically our budgets for, even though we buy things for a lot of money. Our budgets for development projects are between $5 and $50 million, right? So, and we have an enormous inflow of, now that people are aware of our model, of talent that want to be part of it. And so we're pretty good at budgeting. So we're not putting them out we're not doing RFPs. We're basically just getting people that we know are good. We validate them so that they have a little, my kids always talk about Instagram, or you got a check mark, yeah, you're good. We give them a check mark and they become part of our system. And then we start empowering them. We've now done, so the Cordis model now we've done with 4 other companies, 4 other very, very large companies where we're building divisions for them. So our universe of need for people that are developers is growing exponentially.
And so is there a set development house, or everyone has their own kind of development capabilities and they bring those unique skills to the accelerator? So
yeah. They're all running their own shops.
Okay.
There's Ajax is 14 people.
So they win a bid and the budget is 20 million, and then the exit is capped at 60 million. Is that right?
Yeah, and the way they do it is they get 20% of the 60.
Okay.
So they get 12 million.
The investor return from that. And I know none of us here have experienced any delays or going over budget, but what happens should that, theoretically happen?
That happens.
Yeah.
I mean, it's happened to me a million times. It's a process of engagement where people know, in my case now as the investor, which is an odd hat to wear because I've typically been the operator. I have no problem with mistakes or things going over. I have a problem if I don't hear about those mistakes before they happen, right? Like, hey, we got a problem, we got to solve it. But that's just part of medtech development.
Right. So you mentioned earlier, I mean, it sounds like the Cordis X model is working out well. Can you comment on where you are today? Where is Cordis, and kind of what's next? I mean,
so we formalized the relationship with KKR. So our firm's now Ajax KKR, which gives us enormous horsepower to do this. The model expanded from buying the chassis. So if you remember, we bought Cordis and then we surrounded it with growth. Now there are companies that are coming to us and saying, hey, listen, can we do the Cordis X thing, but we're a 20 or 50 or $100 billion company. We're not going to sell you the company.
Right.
So now what we do is we partner with those strategics and we create growth driver engines. Usually it's building a whole portfolio for them in an adjacent space that they want to go into.
Right.
And that's what we're doing now.
Right. That's fascinating. So when I was thinking about, well, would some of the larger corporates, would they, do you think, is there a champion internally that could, that has the political will and strength and the time left in their career to do this? Do you think that's feasible? Are you getting that level?
I think the market's shifting, right? Because they need the innovation. I'll give you a data point. About 12 years ago, I was at a meeting in Silicon Valley with maybe the top 10 or 12 venture investors in the medtech space or in the healthcare space. And we were sitting around the table and I said, what we should do is we should take one therapeutic area and everybody should decide that they're going to build one thing instead of trying to compete against each other. And they all looked at me like, this guy's lost his mind. And then I went to Medtronic, I went to Boston, I went to all the big companies. I said, hey, listen, like, instead of us building things and hoping you want to buy them, why don't you tell us what you want to build and we'll build them for you? And they wouldn't do it. Now there's a receptivity factor that's much higher, right? So now the world's changed and orchestra's doing it. There's a recognition that they need innovation. It's got to be built in-house, or I'm sorry, out-of-house. There's also incredible pressure on earnings per share, right? So they don't want their R&D budget to swell to try and develop products. They have, those 25 med tech companies, they have $200 billion. The top 25 med tech companies in the world have $200 billion in balance sheet power. $200 billion. So they have no problem buying technologies off their balance sheet.
Yeah.
But you've got to convince them somehow that you're capable to be able to execute for them. And I think the market's changing. I think that there's going to be more synergy between developers and companies that are starting and big companies.
Right. So I have to ask this question, last question. We're in Southern Europe, and it sounds like, with Cordis, you're developing products in the U.S. I don't know, maybe not necessarily for the U.S. market. How do you think about kind of the international component here for the types of products, the types of opportunities? Obviously, the regulatory environment and thus commercial environment has been challenged in Europe recently, and it's quite opaque. Is that a factor?
Yeah. So Europe, for Cordis, Europe represents about China represents about 30% of our sales. Europe represents about 20% of our sales, and then the U.S. is about 45% of our sales in smaller countries. So we take a global perspective. So when we're figuring out that portfolio, we're looking at, okay, how is this going to sell in Europe? How is it going to sell, et cetera?
Yeah.
The common denominator is cost has to come down, right? So as we're thinking about new technologies for Cordis in the U.S., we have the burden of trying to make it work in Europe, where reimbursement doesn't comply with what your reimbursement looks like in the United States, which it allows you to, forces you to be more disciplined in terms of cost, which I think is positive.
Yeah. So final thoughts for this audience, since it's incredibly inspirational.
I'm totally bullish on medtech. If I hear one more biotech investor saying medtech is for the people that just have human hearts, and biotech is the area for people that want to make money, I'll be very disgruntled. I feel like this is a very, very interesting time. I've never seen more strategic interest in innovation. I think the onus is on us collectively to figure out new ways to align with these buyers, the strategics. If you can do that, it's going to open up a lot of efficiency and take away the sort of the black mark of medtech being a poor asset class for investment.
Yeah. Thank you. You have an incredibly inspirational story. I encourage everyone to read the article and learn more. Thank you, Scott, for this wonderful forum, and hope everyone has a wonderful rest of the conference, rest of the day. Thank you.